His name is David. He has a PhD in mechanical engineering from a top 10 university. Every morning, he reads the Wall Street Journal before work. He has a spreadsheet with 12 stocks he has been tracking for 3 years. He can explain what a price-to-earnings ratio is, what a yield curve inversion means, and why the Federal Reserve's rate decisions affect equity valuations. He talks about the market at dinner parties. His co-workers consider him the smart one when the conversation turns to money. He is 58 years old. He has $39,000 in savings, not because he was unlucky, not because he never earned enough. Because every year, for 30 years, his intelligence convinced him to do something other than the one simple thing that actually works. He's not lazy, he's not reckless, he's not one of those people who spent everything and saved nothing. David researched, David analyzed, David waited for the right moment, the right setup, the right information before acting. He behaved like a professional investor and produced results worse than a complete beginner who never read a single financial article. And that is the point. That is not an accident. The skills that made David exceptional in every other area of his life are the exact same skills that kept him from building wealth. Intelligence, in the world of money, is not an automatic advantage. For a specific and predictable set of reasons, it is often the trap. This video is not about financial ignorance. There are enough videos about what people do not know. This one is about something more dangerous, what smart people know and still cannot seem to use. The problem is not that people like David lack information. The problem is that information without the right behavioral framework is fuel for bad decisions rather than good ones. Today, the specific mechanisms that keep intelligent people broke, why analysis becomes the enemy of action, why credentials create blind spots, why ego is the most expensive financial liability a smart person carries, and what Warren Buffett understood about wealth that most people with advanced degrees have never grasped. Here is something that almost nobody says directly when they talk about money and intelligence. The skills that earn you top marks in school, analytical thinking, attention to detail, finding the optimal solution, never committing until you have sufficient information, are the exact opposite of the behavioral traits that build wealth. School rewards certainty. Money rewards action under uncertainty. School rewards complexity. The best financial decisions are almost always simple. School trains you to find the right answer before you move. Markets have no right answer. They have better and worse responses to incomplete information, and the person who responds faster at good enough usually outperforms the person who waits for perfect. Think about what academic and professional training actually instills. You gather data, you analyze patterns, you build models, you test hypotheses. You revise. You present your conclusions when the evidence is sufficient. In financial markets, by the time the evidence is sufficient, the opportunity has already been priced in by everyone who acted on incomplete information 6 months earlier. The person who moved with 60% certainty captured the return. The person who waited for 90% certainty bought at a much higher price, if they bought at all. Buffett is not immune to this pattern by being smarter. He is different because his process does not require certainty before acting. His process requires understanding and patience, which are distinct skills. If you have never heard money explained this way before, subscribe to this channel right now. This is where we break down how wealth actually gets built. Not in theory, but in numbers, in behavior, in the decisions that separate the people who accumulate it from the people who spend their careers studying it without ever having enough of it. Buffett said it directly at a shareholder meeting in 1999. Quote, "You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. That line sounds like humility from a man worth hundreds of billions of dollars. It is not humility. It is a precise and empirically grounded observation about what actually drives long-term investment returns. The variables that matter: patience, emotional discipline, the ability to hold through volatility without reacting, the willingness to do ordinary things for decades, have nothing to do with intelligence. They are behavioral traits, and high IQ individuals are, on average, measurably worse at several of them, not better. Buffett has said, in multiple letters and interviews over the years, that temperament is more important than IQ in investing. Not once, many times. It is not a throwaway line. He genuinely believes that a person with average intelligence and exceptional emotional consistency will outperform a brilliant person who cannot manage their own reactions to price movements. The reason is structural. Markets are engineered to provoke reactions. Prices swing. News cycles create urgency. Fear spreads faster than data. The intelligent person's brain interprets every price signal as a data point worth processing, every market shift as a pattern worth analyzing. That constant processing drives activity. That activity generates transaction costs and behavioral errors. The emotionally steady person ignores most of the signal. The returns compound quietly in the background. Call this the intelligence trap. It is not a story about people who are too foolish to manage money. It is the opposite. It is about people who are smart enough to make excessive complexity feel justified, smart enough to construct elaborate reasons why the simple answer is probably insufficient for someone with their level of understanding. Your brain was shaped through years of training and professional performance to solve hard problems. Wealth is not a hard problem. It has a straightforward solution that requires, above everything else, consistency over time. When a high-performance brain is aimed at a simple problem, it does not accept the simple solution. It improves on it. It finds the edge cases. And in doing that, it walks past the door that leads to financial independence. If that pattern sounds familiar, if you have been researching instead of moving, write in the comments right now. I choose action. That is where the shift begins. In 2001, two professors at UC Davis, Brad Barber and Terence O'Dean, published a study analyzing the trading behavior of 66,000 households over 6 years. The finding was blunt and reproducible. The more frequently you trade, the less you earn. Households in the top quintile of trading activity underperformed the market by an average of 6.5 percentage points per year. Households that traded the least came closest to capturing the market's full return. That gap, compounded over 20 years, is the difference between retiring with security and working past the age you plan to stop. The problem in those portfolios was not ignorance of the market. The problem was overconfidence in one's ability to read it. Here is how it works for intelligent investors specifically. They read the earnings reports, they track analyst upgrades and monitor sector rotation data, they watch macroeconomic indicators, they feel informed because, relative to most people, they are. That information creates confidence. That confidence creates activity. Buying when they sense opportunity, rotating away from positions when they sense risk, timing entries based on what they have learned. The problem is that everyone with institutional access to information is doing the same thing. The data they found has already been priced in by the market. Acting on it produces average or below average returns at above average transaction frequency. The well-informed investor has worked their way into underperformance. The Dunning-Kruger effect is typically described as the phenomenon where incompetent people overestimate their ability. But there is a second phase in that curve that gets far less attention. After the peak of overconfidence, truly deep expertise produces a recalibrated humility, an awareness of how much remains unknown. Smart people in finance often get permanently stuck in the middle of that curve. They know enough to feel justified in making active decisions. They do not yet know enough to recognize how much the market has already accounted for what they found. That middle zone is where overtrading lives, where market timing feels rational, where picking individual stocks feels like applying genuine skill, where the idea of just buying a broad index fund and leaving it alone seems beneath someone of their analytical capability. Compare all of that to Buffett. He does not try to time the market. He has stated explicitly in writing and in interviews that he has no reliable prediction for what equities will do next quarter, next year, or over the next decade, and that this lack of predictive ability does not concern him. He reads, he thinks, he waits. When a business he understands deeply is available at a price that provides an adequate margin of safety, he acts. Then he waits again. Berkshire's portfolio turnover is close to zero. He held Coca-Cola for over 35 years. He has held American Express since the early 1960s, See's Candies since 1972. What looks like inactivity is, for Buffett, the entire strategy. And here is the data that should resolve every debate about active management versus passive indexing. Over any rolling 20-year period, approximately 90% of actively managed mutual funds underperform their benchmark index. Not 20%, not half, 9 out of 10. These are professionals with chartered financial analyst designations, with full-time research departments, with direct access to company management and institutional order flow that no retail investor can match. They are the highest concentration of financial intelligence in the room. The simple index, no manager, no strategy, no analyst, a fee of 0.03% per year, beats the majority of them, every decade, by a measurable and documented margin. That outcome is not random, it is predictable. If this is making things clearer, hit the like button right now. It helps more people find this content at exactly the right moment. In 2004, the psychologist Barry Schwartz published research that became known as the paradox of choice. His central finding: beyond a certain threshold, more options lead to worse decisions, longer delays before choosing, and lower satisfaction with whatever choice is eventually made. Smart people are option-generating machines. A simple question, should I start investing, transforms in an intelligent mind into a branching decision tree. Index funds or individual stocks, Roth IRA or traditional, tax-advantaged account first or taxable brokerage, invest now or wait for a more favorable entry point, lump sum or dollar cost average. Each of those questions is technically valid. The act of holding all of them open simultaneously is the mechanism that produces paralysis. The more capable the mind, the more questions it can hold open at once. The more questions held open, the longer the delay. And this is where the real cost becomes visible. Consider two people who are 25 years old in the same year. The first reads about investing, feels uncertain about the right approach, and decides to gather more information before committing. He revisits the question every 12 months, each time finding new variables worth considering, new risks worth accounting for. The second has no idea what an expense ratio is or what the yield curve does. She opens a brokerage account, sets up automatic monthly contributions of $200, selects a broad index fund, and does not think about it again. By the time both are 55, the first has completed a significant amount of financial research. The second has approximately $450,000. That gap was not created by intelligence. It was created by the absence of analysis. Buffett has described his own investment approach in a way that directly addresses this. Quote, "I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over." That is not a statement about being unambitious. It is a statement about the geometry of return. The genius in that sentence is the willingness to find the simplest path that reliably works and stay on it, despite every competing option that looks more impressive. The 1-foot bar is the index fund, automatically funded, held for decades. Anyone can step over it. The reason intelligent people frequently do not is not inability. It is the conviction that someone with their background should be capable of a more sophisticated answer. That conviction, the belief that more intelligence should produce a more sophisticated financial strategy, is where academic training becomes a liability. 12 years of formal education reinforced one message in every discipline: complex problems require complex solutions. The more variables involved, the more analysis is required. The best answers are the ones that account for everything. Every one of those principles is valid in engineering, in medicine, in legal reasoning. None of them apply to personal finance. The research on this is unambiguous and has been for decades. The simple strategy outperforms the complex one. Lower fees, less trading, more patience. No optimization algorithm, no sector rotation model, no carefully timed entry point has consistently beaten the person who automated their savings and went to live their life. The complexity is the cost. But here is the most dangerous part of the analysis freeze. It does not feel like paralysis. It feels like diligence. The person caught inside it does not experience themselves as stuck. They experience themselves as being careful, thorough, responsible with a serious decision. They are reading articles. They are comparing fund families. They are building models. They feel progress. The brokerage account disagrees. Every month of analysis is a month of compounding that does not happen. And at 10% annual growth, every year costs more than the one before it. The year you delay at 25 costs you less than the year you delay at 35. The person who started imperfectly at 25 has been ahead of you since the first deposit. If you recognize the gap between knowing and moving, check the first pinned comment below this video. It is there for people who are ready to stop studying the machine and start building theirs. Here is the category error that costs intelligent people the most money over the course of a lifetime. Being exceptional at one domain does not produce competence in a different domain, no matter how challenging the first domain was. A brilliant cardiovascular surgeon can have a devastating investment portfolio. A partner at a top law firm who structures $100 million deals can have zero net worth at 50. A software engineer with multiple patents and a top-tier salary can be unable to build a retirement account. This is not a contradiction. It is a predictable result of one specific mistake: believing that being good at hard things transfers to money. Money does not reward expertise. It rewards consistency, patience, and emotional restraint. Skills that have nothing to do with how well you performed in professional training. The student loan calculation is the clearest example of this category error in practice. Smart people take on large graduate school debt because the math appears to support the decision. A $150,000 investment in a credential that increases earning potential by $40,000 per year. On paper, that returns the investment in less than 4 years. The calculation is correct in isolation. What it systematically fails to account for is the compound cost of that capital over time. That same $150,000 invested at 25 in a broad market index fund and not touched until 65 would be worth approximately $1.3 million. Not spent, not reduced, compounded for 40 years. The degree may have been the right career decision. It was also a financial decision with an enormous hidden price that most people with the intelligence to calculate it never calculate. The numbers on graduate professional debt in the United States are stark and consistent. The average medical school graduate carries approximately $250,000 in debt at graduation. The average law school graduate carries $130,000. These are individuals who scored at the top of standardized tests, who competed for years to earn admission to selective programs, who approached the decision rationally and with research. They are beginning their professional careers at the age when the most powerful compounding window of their financial lives should be opening, starting instead at negative 130,000 to negative 250,000, with monthly repayments that absorb the capital that compounding needs to work. Buffett's own credential story is instructive here. He did not pursue the most prestigious or extensive financial education available. He studied value investing under Benjamin Graham at Columbia Business School in his mid-20s. Not a doctoral program, not a multi-year credentialing process, but a specific seminar focused on one clear and applicable framework from the person who developed it. He found the right knowledge from the right source at the right moment in his development. He did not accumulate credentials to signal intelligence or demonstrate preparation. He acquired one framework and has applied it with consistency for over 70 years. The difference between a credential and a framework is the difference between what impresses other people and what produces results when the market opens Monday morning. And here is the irony that the financial industry rarely acknowledges. Many certified public accountants carry personal credit card balances. Many credentialed financial planners have below-average personal savings rates. Some of the clearest thinkers about economics work in academia on salaries that would impress no one and retire on pensions they did not optimize. The knowledge is legitimate. The credentials are real. The implementation is the gap. Knowing the mathematics of compound interest is not the same as automating a monthly contribution and not touching it for 3 decades. Knowing the mechanics of debt paydown is not the same as cutting the subscription services and rerouting the money. There is a distance between financial literacy and financial behavior that intelligence does not automatically bridge. Smart people tend to be excellent at the literacy. The behavior is where it consistently falls apart. Now here is where it gets particularly uncomfortable for high achievers. David bought a tech stock in 2019 for $30,000. He had researched the company thoroughly, the business model, the competitive dynamics, the growth trajectory. He was confident in the analysis. The stock declined 40% in 2020. His first instinct was that the fundamentals had not changed, and the lower price represented an even better opportunity. He did not have available cash, so he held. The stock partially recovered in 2021, then declined again through 2022. For 4 years, David did not sell, not because the business improved, because selling would mean that the original analysis was wrong. He sold in 2023 at a 60% total loss. His $30,000 became $12,000. The analysis was not the problem. The ego that had been invested in defending the analysis was. This pattern has a name in behavioral economics, the disposition effect, the tendency to hold losing positions far longer than is rational and to sell winning positions far earlier than is optimal. Smart investors are among the worst affected. For them, the mechanism is specific. Cutting a loss requires admitting that a carefully researched decision was incorrect. And admitting a mistake is cognitively costly in exact proportion to how much intelligence and identity were embedded in the original judgment. The more research you conducted, the more certain you were, the more your sense of competence was attached to being right about this, the harder it becomes to close the position when the thesis fails. The loss is not only financial, it is a verdict on your analytical capability, which is the thing you most identify with. Research on this is consistent. Intelligent people are not only more likely to hold losing positions, they are more skilled at constructing the justifications that make holding seem reasonable. A person with strong analytical ability, when confronted with a bad investment, does not simply register the loss and correct. They identify new data points that are consistent with the original thesis. They build scenarios where the recovery occurs. They find structural reasons why the current price is wrong, and their analysis is still valid. The brain does not fail in these situations. It performs at its highest level. It becomes a skilled attorney, defending a client it has decided to protect, regardless of the evidence. The more intelligent the person, the more persuasive the attorney. The more persuasive the attorney, the longer the position is held. Charlie Munger had a phrase he used in Berkshire shareholder meetings when Buffett finished explaining a decision, and Munger agreed completely. He would say, "I have nothing to add." 3 words. It would be easy to read that as modesty from a man considered one of the greatest minds in investing. It was something else. The intelligent thing to do in that moment was silence. The discipline to sit quietly when the ego wants to demonstrate its thinking, to hold a position without explaining it to every person in the room, to resist the pressure to perform analysis in public. Munger's intelligence expressed itself as restraint, not as performance. Most highly intelligent people express their intelligence as performance. They need their thinking to be visible. That need for visibility drives activity. That activity costs returns. The ego tax has a second form that operates just as quietly. Smart people are deeply uncomfortable with saying, "I do not know." When someone asks about a sector, a stock, a macro trend, the intelligent person provides an answer. The answer sounds authoritative. Often it is. Frequently it is a confidence-projected construction built on information that is not actually sufficient to support the certainty being expressed. And once the smart person has stated that opinion publicly, their social identity becomes attached to being right. If they are wrong, they are not just wrong about the investment. They are wrong in front of people whose opinion of their intelligence they value. That social dynamic pushes them toward investments they can explain and away from ones that work quietly without requiring explanation. The broad index fund is the investment you cannot make sound impressive at a dinner party. It is also consistently the one that performs. Now here is something you need to pay attention to, because this is the mechanism that ties all of it together. Smart people struggle to do simple things with money. The capability is absolutely present. The obstacle is different. Simple feels insufficient for someone whose entire professional identity is built around being the analytical one in the room. An index fund that returns approximately 10% annually, requiring zero management and zero expertise to access, does not satisfy the intelligence's need to add value somewhere. If anyone can do this, what advantage does your education provide? The brain that has been rewarded throughout life for being the exceptional one searches for the strategy that requires genuine understanding to execute. The move that the uninformed investor cannot access. The alternative, just automate the investment and live your life, carries the uncomfortable implication that everything you learned about finance is irrelevant to the outcome. So the search for complexity begins. Options strategies, private equity opportunities, thematic exchange-traded funds, cryptocurrency positions, leveraged products, real estate syndications, currency trading. Each of these strategies has generated returns for someone at some point, which makes each of them defensible as a choice. Meanwhile, a retired high school art teacher in Ohio opened a Vanguard account in 1994, contributed automatically every month after reading a single magazine article, selected a total market index fund, and forgot about it for 27 years. In 2021, she had $800,000. She could not define a price-to-earnings ratio. She did not know what an expense ratio was. She just did the simple thing, without second-guessing it, and let time complete the work she had started. The data on this comparison is not disputed by anyone with access to the research. Vanguard, Morningstar, and the S&P Spiver report All track the same metric across different time horizons. Over any rolling 20-year period, approximately 90 to 93% of actively managed mutual funds underperform their benchmark index. These are not amateur investors. These are credentialed professionals with institutional research budgets, access to management teams, and decades of dedicated experience in their asset classes. They bring every advantage that intelligence and resources can provide. The simple index, no manager, no thesis, no view on the macro environment, consistently outperforms the majority of them. Not in isolated periods. Across every measured 20-year window, the simplest product wins by the widest margin. Buffett addressed this directly in documents he made public. In the instructions he left for his estate, he directed the trustee with specific language, place 90% of the funds in a very low-cost S&P 500 index fund and 10% in short-term government bonds. Not a hedge fund allocation, not a portfolio of his own stock picks, not a multi-strategy approach designed to capture multiple return sources, an index fund. If the greatest investor in the documented history of financial markets, the person who has compounded capital at approximately 20% annually for 6 decades, chose an index fund as the financial plan for the people he loves most, the question worth sitting with is why your situation requires anything more sophisticated than that. The complexity addiction is ego operating inside financial decisions. Every investor who pursues a complex strategy, consciously or not, is looking for the domain where their intelligence creates an edge. That is a rational human need. The problem is that financial markets, by their nature, work to eliminate intelligence advantages for most participants. The information edge that once existed for attentive retail investors has been narrowing for decades, as institutional algorithms process data faster than any individual can read it. What remains is not a game that intelligence wins, it is a game that patience wins. And patience does not require intelligence to execute. You do not need to understand monetary policy to hold an index fund for 30 years. You need to not sell it when the market drops 30% and the financial media is declaring a permanent structural shift. There is an edge, though, a real one. Buffett has it. Munger had it. The index fund pioneer Jack Bogle built an institution around it. The edge is not in the strategy, it is in the behavior. Doing the simple thing when everything around you is signaling that the simple thing should be reconsidered. Holding when markets fall, not adding complexity when complexity feels like the intelligent response. Staying in the boring position when every dinner party conversation is about something more exciting. The person who can genuinely be bored about money, who can resist the optimization impulse on something that is already working, that person consistently wins. And it does not require a high IQ to do this. It requires emotional discipline that most high IQ individuals have never had any reason to develop. So what does Buffett actually do with his time? He reads 5 to 6 hours every day. Annual reports, financial documents, newspapers, industry research. He has maintained this practice since his 20s. He thinks, often for long periods without acting. He has conversations with Munger and other trusted people about businesses, competitive dynamics, and long-term industry trajectories. Then he waits, sometimes for years. When a business he understands deeply becomes available at a price that offers an adequate margin of safety, a price where the risk of permanent capital loss is genuinely low, he acts. The act of buying is simple. What makes Buffett's results extraordinary is not the complexity of the action. It is the consistency and discipline with which he has executed that same process for 70 years without being distracted by whatever was complicated and exciting in any given decade. The formula that has outperformed brilliant investors since before most people watching this were born is not sophisticated. Automate a fixed amount. Direct it to the index. Do not touch it. Let time complete the process. Nothing in that sequence requires a finance degree. Nothing requires research, analysis, or a view on current market conditions. What it requires is the willingness to do a boring thing consistently, without deviation, for a very long time. That willingness is rarer than any financial credential. It cannot be demonstrated on a resume. It cannot be proven in a job interview. It is a behavioral trait, the trait that Buffett has consistently called temperament, and it is the single variable that most reliably separates people who build wealth from people who spend their careers studying wealth without accumulating it. There are 4 specific changes that break the intelligence trap for good. The first, automate the investment before you can analyze it. Money that transfers to your investment account on payday automatically never enters the decision loop. You cannot overthink what you never see. The second, stop consuming financial media. Every hour directed at market analysis, economic commentary, and investment research is an hour of energy applied to a process where your participation produces no measurable return. Information does not create compound growth. Consistency does. The third, stay within your actual circle of competence. Being an outstanding engineer does not mean you have edge in selecting technology stocks. Expertise in one field does not migrate. Put the money in the index. The fourth, write down rules that remove your ego from individual decisions. Something like, I will not move this money for 30 years. I will not attempt to time the market. I will not look at my portfolio more than once per quarter. Rules replace willpower. Willpower is a depleting resource. Rules are not. Go back to David, PhD in mechanical engineering, 33 years of professional income. He tracked stocks, read financial reports, and waited for the right entry point every year of his working life. At 58, $39,000. Now, run the parallel version. Same income, same cost of living. One difference, at 25, he automated $200 a month into a Vanguard S&P 500 index fund and never thought about it again. No research, no strategy, no analysis of any kind. Just automation and 33 years of time. That account at 58 would hold approximately $650,000. The difference between $39,000 and $650,000 is not a difference in income. It is not a difference in luck. It is the distance between a brain that needed to understand everything before acting and a behavior that acted without needing to understand anything, except that starting was better than waiting. Buffett is 93 years old. He still lives in the same house he bought in Omaha in 1958 for $31,500. He still eats McDonald's most mornings. He still reads for hours every single day. He still holds many of the same businesses he first bought 30 and 40 years ago. His strategy has not evolved because the strategy never needed to. He found the simple answer early, understood why it worked, and has executed it without interruption for 7 decades. In that time, he has outperformed the majority of professional fund managers, financial analysts, and academically trained investors who spent their careers constructing more sophisticated approaches to the same problem. Simple, patient, consistent. Those 3 words are the complete framework. Everything else is noise. The intelligence trap does not catch people who are uninformed about money. It catches people who are smart enough to make complexity feel justified. Smart enough to generate legitimate reasons why the simple answer might not apply to their specific situation. Smart enough to identify real inefficiencies in the market and to believe their intelligence can exploit them. Smart enough to recognize that the advice to just buy the index sounds too simple for someone who understands the system as well as they do. The trap is constructed from genuine insight, real data, and coherent reasoning. That is precisely what makes it a trap, rather than a delusion. The exit from that trap is not more intelligence. It is the willingness to act on incomplete information, automate the boring decision, and let the process run without interference from a mind that has been trained its entire life to optimize things. Start today. Not after you finish the next book on investing, not when the market reaches a more attractive valuation, not when you feel fully prepared to make the right call. Today, open the account, set the automatic contribution, select the low-cost index fund. Start. The amount does not need to be perfect, the timing does not need to be optimal, the decision does not need to be final in every detail. It needs to happen. The person who started at $100 a month 5 years ago is already ahead of the person who has been planning to start at $500 a month since then. Imperfect action compounds. Perfect plans, by themselves, do not. The gap between understanding everything you just heard and actually doing it is where most intelligent people will spend the remainder of their financial lives. The logic is followable. They have followed it. The math is not unclear. Compound growth has been understood and documented for generations. The gap persists for a different reason. The brain that spent 20 years being rewarded for finding better answers will not accept that this answer is simple enough. It will produce one more question to consider. It will find one more variable worth accounting for before moving. It will feel, with genuine sincerity, that proceeding without resolving that variable would be irresponsible. That feeling is the trap. When it appears, name it, and then do the simple thing anyway. You watched this video through to this point. Somewhere in it, something probably connected to something you already knew was true. A version of David that felt familiar. A decision you have been delaying longer than made sense. An analysis that has been ongoing for more months than you intended. That recognition is not a coincidence. You already know something is not working. The only question left is whether your intelligence will construct one more sophisticated reason to wait, or whether you will do the thing that has been ready to be done. Buffett's greatest investments were not his most complicated ones. They were the simple ones he held without second guessing. That approach is available to anyone watching this right now. No advanced degree required. If you made it to the end, write in the comments, "I choose simple." There is another video on your screen right now, the next step in understanding how money actually works. Thank you for watching, and we will see you in the next one.